Should you invest when markets are high? You've probably heard that you're supposed to buy low, and you may have even trained yourself to see a low market as a buying opportunity. So what are you supposed to do when the markets just keep getting higher? Now, I'm going to value your time, so I'm not going to make you wait and watch my entire video so you can find out the answer. Instead, I'm going to tell you the answer right now. But if you do want to see me explain my reasoning, then feel free to watch the whole video. So for most long-term investors that are focused primarily on index funds using, say, the dollar cost averaging method, the answer is probably whatever you were doing before. But let's clear this up early. Things could go horribly wrong this time. So check out the disclaimer at the bottom of our description and make your own decisions, as Connor and I are not financial advisors. So there's two questions to ask yourself before we go further. One, are you a long-term investor? i.e., are you investing for a specific goal that's 10 years or more in the future? And second, do you believe that things won't fundamentally change? That is, do you think that the market will continue to go higher rather than lower in the future? If you answered yes to both those questions, then chances are you're probably a long-term investor. So how should you invest? Well, invest in the same way you would as if you weren't even paying attention to the market at all. See, market highs aren't necessarily bad as a long-term investor. For example, JP Morgan looked at what would have happened historically if you invested only on days where the market was highest. Then they compared that with investing on any random day, non-high market days. And as you see with the graph on screen now, the result is that investing at market highs actually worked out well. Now, that might be because generally the market continues to hit new highs. Plus, they were comparing those days to any random day, and most of those random days weren't actual market bottoms. See, for long-term investors, it's often best to ignore the ups and downs of the market. Instead, focus on your plan and make sure that your money is well diversified according to your risk tolerance. So if you primarily invest in ETFs like Vanguard's VOO on stake, like Connor and myself do, I'll be sure to leave our referral code down in the description below for a free stock when you sign up with our code. So if you do invest like Connor and I do, you shouldn't really worry about the market hitting new highs. It's supposed to do that. The market can never be too high to invest if you expect continued expansion. Now, if you're a short-term trader, you've come to the wrong video for information. But for the long-term investors, the best course is just to continue investing according to your plan, regardless of what the market does. You may be buying high this month, but the market might continue upwards, and you've probably been buying low in previous months, so it should all come out in the wash. For another example, if we take a look at what seemed to be the highest the market had ever been at the time in 2007, yes, the market dipped for the next 6 years, but naturally, as history shows us, it bounced back in 2013 and since has only remained higher than its 2007 valuation. So for someone that uses the dollar cost averaging method as a long-term investor in an index fund, they would see more dismay from not continuing to invest through the highs and lows than if they were to just try and time the market when it's at its lowest. And that reality is the beauty of index funds. Any ordinary person like you or me can continue to invest with our long-term strategies, regardless of monitoring the market. And as a result, it requires very little brain power to just be consistent. Now, what about a lump sum? You might be on board with long-term thinking when it comes to small monthly contributions to your retirement plan, as Connor has gone through in the past. But what about a large lump sum of money? See, one-off situations like that require careful consideration, but that doesn't mean you should hold off from investing when the markets have been rising. Instead, you should think about how you would feel and react if the market fell immediately after you invested all that money. Keep in mind that you don't have to invest all of it at once, but whatever you do, it's best to set up a well-defined strategy and follow it through. If you decide to invest over the next 12 months, try and automate those investments so that you don't have to deal with the logistics every month. And more importantly, you're not tempted to make changes every month. And like me, you'll stop looking at the highs and lows of the market and just continue on the ride regardless, essentially eliminating self-doubt from your strategy. So that was pretty much it on whether you should keep investing when the market is high or not. I hope I covered enough in this video for you to make an informed decision on whether you should keep investing while the market is high or not. If you have any questions on things that I didn't touch on, just leave them down below and I'll try and reply to as many people as I can. But if you enjoyed this video and others that Connor and I make, consider subscribing and leaving a like on the video, as it really does help us out a lot. Here is a video that YouTube thinks you like, and here is our last video.